Okay, now we're gonna go over some special rules for net income. So this might be stuff like if a person's not trying to like cheat the government and like try to pay less taxes somehow, then the government will like crack down on that and be like, what up, loser, there are taxes, there are rules against that. So to begin, we'll go over this thing called inadequate consideration. So let's say, so consideration, remember consideration is basically like the money that you give, money given for something, or the money that you get like in return for like a good, for a good. So we're going to talk about inadequate consideration, like maybe like you're giving or you're getting too less money or getting too much money for like the sale of some property, let's say. So to begin, let's assume that I sell something at a higher price than my fair market value. So this one over here. In that case, my proceeds is basically the selling price. And this is what it normally is, right? Like if I sell something, my proceeds is basically the amount of cash that I get. Proceeds is cash. And then like my ACB, all right, so ACB is called adjusted cost base. Basically just like a fancy way of saying cost. So my cost will be like my original cost, and that will be my gain, right? Like how much gain I've had holding this thing for like a couple of years or whatever. And so if I'm selling something at a higher price than my fair market value, then normally my proceeds will be my selling price. Cool. One thing is that for the buyer, when the buyer buys it, even though they're gonna pay like, let's say this much dollars, for them, the cost that they're gonna put it down as, like this cost over here, like if they were to sell it in the future, it would be fair market value. And this might just be sort of to represent the fact that like how could you can't like change the cost of something, right? Like the cost of like the thing that you're buying right now should either be that the cost that it was like, 300 years ago when it was first made, or whatever cost it was when you're buying it. And like not realistic, but like more accurately, I think that cost would be fair market value, just because like, it is a lot, I don't know, better, I guess. I don't know. So we're just going to use fair market value for the buyer's cost, and the seller is going to be basically selling it at the selling price. Yeah, this kind of makes sense. Like, just like what else would you use? You can't like say that the cost is like $1 billion, right? Wait, actually, hold up. You know what is funny? If I'm selling something at a price lower than okay, I don't even need to know this. Okay, whatever. If I'm selling something at a price lower than the fair market value, for a seller, it's deemed to have been sold. Why the hell is this so big? It's deemed to have been sold. It's because I'm going this way. It's deemed to have been. Oh. Ooh. Okay. It's deemed to have been sold at fair market value, but in the buyer, the cost is selling price. And then if I'm selling this at a higher price, this guy's selling price and this guy's fair market value. So it's just like the other way around. And I think what the gist of this is like to sort of represent like that you're not paying too much of a gain or you're not paying too less of a gain. Like, let's say that my selling price is greater than my fair market value. And so I say that my proceeds is fair market value. And then the buyer also sets their cost as fair market value. In that case, since the selling price is greater than the fair market value, so the fair market value is less than the price, that means that I'd be reporting a lower gain, right? Because like this proceeds thing would actually be fair market value, which is less. And then for the buyer, since they're also using the fair market value and not like the higher cash that they paid, they're also reporting a lower gain. And it's more of like, I guess it's to sort of show that we have to sort of represent the fact that there is a higher amount being paid than the fair market value. So who's going to pay taxes on this amount? Who's going to pay taxes on like this amount if both people are reporting it as being sold at this amount and like being bought at this amount, right? You have to sort of incorporate the fact that this guy is like the price is in there and the price is like higher. So that is, I think that's like sort of the gist for why it's like you have to have one guy selling price, one guy fair market value. And so I guess one thing to remember is, okay, let's just remember this. If I'm selling it at a price greater than the fair market value, because I can sort of imagine that because I kind of understand why somebody would want to do that, like I want to make like a bigger gain or whatever. And in that guy, the proceeds are going to be the selling price. And for the buyer, the cost is going to be the fair market value. Oh, okay. Also, another thing, for the buyer, the cost is always a smaller number. PP. And the seller is always a bigger number. That's another way to remember this. That's pretty cool. Okay, seller is higher number. Okay. Okay. Okay, I am taking way too much time here. Next is gift. So if I'm gifting something to somebody, in that case, it's as if both things are being at fair market value because there's no like extra price being involved anywhere. So like for me, the proceeds that I get would be the fair market value. And then for the buyer, their cost would be also fair market value. That's just another thing. Okay, next, oh, there's so much. Okay, next we have this thing over here. Let's say this is about like corporations ownership. So let's say we have A who owns like 60% of corporation, B who owns 40% of corporation. They both own the same corporation. If you control something, then you're related to it. So A controls corporation because it's greater than 50%, so he's related to it. B does not own more than 50%, so he's not related to it. But if A and B were related by like marriage, child, parent, stuff like that, then B would also own corporation. One thing to note is that if it's 50%, like instead of A being 60, it was 60, that is not that's not control. Because I guess to control you have to have greater than 50%. Apparently, I didn't know that. I mean, I feel like I should, but. Next over here, we have this thing over here, X, Y, and Z. All three of them own less than 50%, so none of them own it. But if we had that X and Y were like related, like let's say by parent, sibling, child, stuff like that, then these two things total would be 70%, so these guys would own it together. So so these guys would own it together, so they'd be related. Okay, the point of this is to show like who was related. Because if people are related, they're like sort of different rules. Because the government might be like, like what if you're trying to like cheat the government by like, selling things at like a lower cost or something like that, Which is why we need to sort of recognize who was related, like what individuals and entities are related and who is not. Okay. So for example, let's say that I'm selling something to my spouse. So for this thing over here, so we're going to sort of assume that a spouse is sort of like an extension of yourself. Like you're like just sort of like the same person, So if I'm selling something to my spouse, that doesn't really mean that I'm doing like an actual sale. It just means like I'm like just like moving this like maybe like this bond or whatever, just from like my hands to her hands. Right? Okay, I'm assuming I'm a guy right now. I'm a girl. So we're just moving it to her hands. And in this case, it's not really like a sale. It's just like a transfer of property kind of ish. So for her, the cost would just be like the original cost. Like there's no like fair market increase or price or whatever that we have to like recognize for this. Because basically we are saying that there's basically no sale. And as a result, since when I am selling this, let's say my proceeds less my cost equals my gain, and this is the thing that's going to be taxed. This is the taxed income. My proceeds is my cost as I'm selling this. My cost is also my cost because, like, remember? Like, okay, cost is cost because, like, that's cost. But the proceeds is cost because in this case, we're assuming that it is sold and acquired at cost because it's not like an actual sale. So in this case, I have no gain, so no taxable income. What does this mean? Basically this means that I don't really pay any taxes on the gain to it. But what this does mean is that if in the future the spouse decides to sell it and they sell it for like, I don't know, some like fair market value and they sell it at, remember cost is going to be, for them the cost is going to be the cost. This difference would, I think, apply to me. I'm gonna refer back to that. Is that the attribution thing? Blah, 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 blah. Yeah, okay. Yeah, so that's actually in the next section over here, attribution. So I'll talk about that later. I mean now. So attribution basically means a gain, a loss, or an income is attributed to, basically given to another. So in this case over here, I am sort of giving this property to this, like to the spouse. And so this spouse, so like right now I pay no taxable income, but in the future when the spouse does sell it, sells it, they get like this sort of gain, right? The thing is, it's as if this sort of sale never really happened. It's as if I still own it. So any type of income, any type of gain that comes on this goes to me. That is what attribution is called. Okay? So like, let's say right now, it's like we have a spouse and we also have a kid. And let's say that in order to, I don't know, let's say I like gave some kind of property to a wife or a child, and right now the child has the asset, but the thing is I am the one who's going to have to pay taxes on it because of attribution, because of the fact that it's as if I still own this thing. Cool? Cool. And the thing about transferring some property to spouse is that, like, so any like income would be in my income, any gains, losses would be in my income. And similarly for interest-free loans, like if I were to give the spouse an interest-free loan, in that case, it would be like, I'm thinking, also same for interest-free loans. If I'm giving a spouse an interest-free loan, that's like a benefit for her. But honestly, it's more as if I just sort of like transferred some money. It's an interest-free loan. You can just think of it as like just like giving your kid like $10 for like, I don't know, lunch money or whatever. So it's not really like a sale. It's not really like a big deal. It's sort of just like transferring money. So in that case, it's still going to be under my income. Okay? Because as if it's not like an actual transfer. If I were to sell it at like the correct interest rate and everything, in that case, like you would have to, there'd be more proof that it's like an actual like sale-ish, like an actual transfer. But for interest-free loans or any like interest benefit loans, in that case, it would be like me. Like it's all my income. And attribution kind of sucks for the seller because they're the ones who still pay tax on it. So they're kind of mad. They're kind of sad. Okay, let's say they transfer some property to a minor child. Income, any income again that the minor child gets. Like for example, if I sold them a bond or a stock and they get some dividends, that would be attributed. So dividends, I would pay taxes on it. Another thing is dividends also go to me. Like the actual money is mine. It's not actually the child's. And that's why like I pay taxes on it, right? Because it's like under my net income for tax purposes. When I have like my dividend income, it's like $200 from this child's income, blah, blah. One thing though is that capital gains and losses are not attributed. So like if the child were to like sell it in the future. Also one thing to know is a minor child, so less than 18 years old. But also capital gains and losses are not attributed. So like if the minor child were to sell it, I'm not really sure why. Maybe because in that case it's like, but like why? Because not attributed. Like, because if it's a spouse, then when you sell it, when the spouse sells it, this gain comes to me, right? Let me check that. Transfer property spouse, still in my income. Oh, actually, hold up. I don't even know that. Because it didn't really say anything about the spouse capital gains and losses. Let me just quickly go over there. Blah, blah, blah. Blah, blah. Interest-free loans, attribution, manner, loan, addition. In addition, the spouse who made the transfer must recognize the related gain on the transfer if the value is greater than the cost. Okay, never mind. Okay, it doesn't really tell me anything. We're going to assume that we don't need to know that. I was going to assume. But anyway, just to remember, capital gains and losses are not attributed. So if we would actually sell it, it's like a big deal. So it's not like a little transfer between family, okay? TOSI, this is a big deal. This is actually why I even made this video, and then I started adding in other stuff. TOSI is tax on split income. So we're going to look at a little drawing here. So first, we've got this business owner. So this guy, he owns a private business. He's like the owner of a business, and he gets an income of $100K. And because of this income of $100K, he has to pay $17,000 in taxes. And this is because of the progressive tax rate, right? Like as your income goes up, you pay more taxes and all that stuff. So he pays a lot of taxes. The thing about private businesses, though, is that you don't really need to display your income. And you don't really need to display your information income. It's not like it's on like a public market, right? Like where everybody can see it. So it's kind of hidden. And it's also not like you're working for somebody where you get like you get like a T4 that has like your salary exactly. So the thing is, the amount that you can earn from a private income is really like it's hidden. You could fake it. So what this guy could do is, instead of having to pay $100K all by himself, he decides to give $20K to each of his 3 kids. So $20K, $20K, $20K. Oh, oops. Okay, this should be $40K. That means that he has to pay taxes on about $40,000. And that tax is going to be a lot lower. One, because the actual income is lower, but also because of progressive income taxes, right? Like you're paying taxes like a lower income bracket. So it's like a lower tax. And the 3 children also pay this. Taxes that they pay are going to be at the lower income tax. because like they're not like it's just from 0 to 20K. That's like the lowest income bracket, whatever. So they only pay like a very less tax. And if you were to add these three things up, there would be way less than 17K. I think the actual amount is like around like 14. No, not 14. Maybe like 4,000 to 5,000. That means that you're like basically saving on like about $10,000, $12,000 just because of like giving them money, just because of splitting the income right here. And so what the government is like, what? These guys can't just do that. Like, what the hell? So the government is shocked, and they've decided to put in a new law called the TOSI law. I don't really know when they put this in. I don't know if it's called TOSI, it's probably TOSI, but TOSI for me. The law basically says that any of the split income, so anytime I split income like this, it's going to be taxed at the highest rate and not the lower rate. So all these 20Ks, these would actually be taxed at like the highest income rate. So like if I'm making like 125K and above income, what would my income tax rate be, like 45%, whatever? I don't really know if that's a number, but that is how much taxes I'd have to pay. So basically I can't really gain on the fact that I'm paying these 20K at like lower tax brackets. And that sort of like basically gets rid of the entire incentive for you to even do this thing, for you to split your income. And officially, this is not like the official thing because it's like a very specific example. But for one example, any dividends to the minor child from a private Canadian or foreign corporation. Remember, it has to be private because if it's a public corporation, then like the amount, like one thing about public corporation is that, you know, like the amount, like the financial statements and everything are like released every year. So like everybody knows. So in this case, any private Canadian corporations or foreign corporations, any dividends that a minor child gets, it's considered split income, and so it would be taxed at the highest rate. One thing is, does this mean that, because doesn't a minor child mean that the parent gets it? Like, wouldn't the parent have to be dividends received by minor children directly or through a trust from a private Canadian foreign corporation are referred to as split income, blah, 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 unless, and are not subject to attribution rules described in the above paragraph. What does this mean? What is attribution? Okay. I think this basically means like if it's not like sold to you from your parent or like sold to you or gifted to you from your parent, like this is like directly, like either I am the one who decided to buy the bond or like it's like from like a trust that's in my name. In that case, it would be like it would be my income, but it would be taxed at the highest income rate. And yeah, because like sometimes I guess people might decide to like, you know, like give the, like people might just ask like, yo, like child to go and buy the bond. I don't really know if that's how it works, but they could do that in order to like avoid this attribution rate, right? But thing is, because like if the attribution thing was in place, then the parent would have to pay taxes on that thing, and their taxes would increase because of that dividend income. But in this case, if you're asking like just like your minor child to do it all themselves, it's still taxed at the highest rate. So there's sort of like no benefit to it. There's no benefit basically to the minor child having this bond. Like there's no like any like cool thing you can gain on it, which is what the government's trying to do, I guess, you know, crack down on that stuff. One thing, okay, so TOSI is a bad thing. Well, not a bad thing, but like bad. Oh my God, it's TOSI. TOSI is a bad thing for the taxpayer because they are paying more taxes, right? But now we got some exceptions to TOSI, which is actually a good thing because we are not applicable. Like we don't have to follow these TOSI rules where you pay stuff at like a higher income rate. For example, let's say that we had a business owner who's over 65 years old. This is a private business, remember? Remember, it's got to be a private business, I think. I mean, it doesn't really say that it has to be a private business, but I think it is corporation. I think it is private, yeah. Blah, 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 blah. Yes, private. We're going to assume anytime is going to be a private business just because, like, or else, like, it's too much information, guys, okay? So for private business, we got, like, a really old business owner. He's literally about to, like, drop dead anytime soon. And then what this guy decides to do is give his income to a spouse. This spouse could literally be any age. They could be, like, 40, which is, like, very young. Or they could be, like, 68, whatever. It doesn't really matter. But if they were to give their money, their income, in that case, you would not have to worry about TOSI. The spouse would pay it at their own, like, lower income rate, which is nice. I don't know why this rule exists. Maybe because this guy is, like, super duper old and they want to be like, man, like, we don't want to stress you out too much. I don't know. Like, it's like old people, you know? Next, we got excluded business. Oh my God, how long have I been talking? Excluded business. I'm not really sure why this rule is called excluded business, but let's say that I work at the company. I work greater than 20 hours a week. So basically it's like not part-time. It's like more than part-time, more than like a part-time job. In that case, I won't have to pay the TOSI rules. I think that's because basically if I'm working like basically full-time at a company, it kind of means that I'm like actually a worker, right? It's not like actually a worker. It's not like I'm like faking the working, right? It's not like I'm like showing up like an hour a week and then my dad's like, oh, look, you will just move the income to you. No, it's like I'm actually earning all this income that I'm earning. So like I'm like actually an employee, and so it would not be under TOSI. Excluded shares. So this is like another thing where I'm not really sure I don't know why it's called excluded shares, but let's say that I am of age greater than 25 years old. I own more than 90% of the corporation. Let's say I own like 90% of, oh my God, no, I own more than 10% of the corporation. So like, let's say if I own 90%, no, 80% of the corporation. And let's say that less than 90% of it's not necessarily shares, money, less than 90% of our income comes from services. So I think this means like if I am a manufacturing company, in that case, like this thing would apply. And in this case, I would not have to pay taxes on this. I'm not really sure why this rule exists, but we're just going to assume it is. Next, we have any return on capital put into business. So let's say that I decided to invest like 10K of my own into the business, okay? Oh, it's supposed to be a building, but it's a bit bad. I put like 10K into this business, and the business like makes like a whole bunch of money, and like my 10K turns into like 30K. So my return is 30 minus this original 10 equals 20K. I get this much of like gains basically. So this return on capital, it's not under TOSI. Not really sure why. Maybe it's sort of what the hell was that? Maybe it's sort of to represent that you're sort of like an investor? I don't know. Oh no, I didn't realize this was like a thing. But yeah, I think that's sort of like the gist of it. There are like a lot of other rules too. Like there's not just these 4 exceptions. There are a whole bunch of exceptions, but these seems to be like the more important exceptions. So that's it for today, guys.